lot of terms to go through today. You covered a number of them, but I do want to start with a lot of the economic data, and I know we've been spending a lot of time talking about that, but it's so important because that economic data, Derek, really is driving this fact-based decision that the Federal Reserve is trying to do, and we are still getting really good or better numbers than we expect, which is putting pressure on the Fed to continue to raise rates.
Yeah, it's really on the numbers, it's sort of a mixed bag because the housing data has been universally bad, so is the manufacturing data, but the services data is still strong. On Friday, we saw ISM services came in better than expected. Prices paid was down from the prior month, so people took that as a positive. And the interesting thing about this market is we went from an extremely bullish sentiment profile 6 weeks ago to an extremely negative one in merely 6 weeks. And it just shows that people are not adequately positioned in this current economic environment.
And that really happened because of all of this economic data that we're referring to. You know, the PCE came hotter. We saw a number of things come in. We saw personal income up significantly in January. Now, there's a possibility that some of that will get revised down as we get seasonal adjustments. But you look at what the Fed is going to have to do next week, and it's going to be interesting. You know, with widely expected that 25 basis points is at least baked in, hopefully not 50 basis points because it hasn't been telegraphed yet, but 25 basis points here in March, and to follow a couple of more rate hikes after that. And the term that Danny used to start the show is terminal rate. And I do want to spend some time there because it's really important.
Yeah, the terminal rate is, where the Fed governors, stop hiking the Fed funds rate. And the next FOMC minutes, one of the things we're going to find out is where those current dot plots are, which is what the expectations are for the voting members on where they believe interest rates will go over the coming 6 to 12 months. And that's going to be very instructive. In fact, Neil Kashkari, one of the governors, actually said that's the important thing that investors should be focused on. And at the same time, he was essentially trying to talk down the equity market.
And Neil Kashkari, he's the Minneapolis Fed president. And we see a lot of these Fed presidents kind of yapping a little bit out in front of what we're going to see as the statement from the Federal Reserve. But the reason why we talk about this air quotes terminal rate is because if the rate that they're going to raise to is still not 25 or 50 basis points from where we are, that means that we expect interest rates to go higher. And that's the reason why we spend so much time watching the 2-year Treasury and the 10-year, because both of those, Derek, are still inverted but going higher. We saw a little bit pullback on Friday, but still higher than we've seen over the immediate term.
Right. This year, the 2-year note hit over 4.9%. The 10-year, which you were referring to, it hit 4.08, pulled back to 3.97 on Friday. And the interesting thing I find, for an investor is when you think about your portfolio and you think about the yield, currently the 60-40 portfolio, in other words, 60% stocks and 40% bonds, actually yields less than the 6-month T-bill. And that hasn't happened since 1999.
Yeah, and that's been a long time, and we've been watching those interest rates. But what I do want to come back to and kind of wrap this idea up is if the higher terminal rate, in other words, where the Fed is going to stop raising rates, that's important because that'll be what we talk about as a pause in rate raising. And we've been talking about that now for 6 months. But you think about it for a company, if you're managing a publicly traded company or a small company or even your personal finances, that means the cost of capital, what it costs to borrow money, is higher. So that's going to put pressure on a lot of income statements. We saw earnings season just wrapping up, and they did talk about that a lot.
Yeah, they absolutely did. They also talked about the dollar and what's been going on there, and also the cost of inflation, the higher input costs, which have been, hampering margins, which have led some analysts to reduce their earnings expectations. The irony here is, China is reopening, and we talk about China a lot, but they were basically closed up and down for 3 years. That curbed supply chain abilities, that limited economic growth, demand for oil, demand for other commodities. And as they reopen it, I think it makes the Fed's job even more challenging than it is ceteris paribus, all other things being equal.
That is really fancy talk, Derek. Thank you for that. And of course, we're going to have to go and make sure you go through your portfolio. We do it on a daily basis, folks, and we can help you.